So recently, of course, we've had a breakout in gold, a breakout in silver, and they're the metals are starting to run. This is very, very exciting. It's exciting because there is still so much incredible deep value, and we believe high appreciation potential in our exploration focused stocks. And one way you can see both the relative value opportunity and the timing opportunity here, I think, is just to look at the chart of gold compared to the TSX Venture Exchange Index. Most of the mining explorers around the world are listed in Canada. There's a lot of them listed in Australia too, but most of them are listed in Canada on the TSX Venture Exchange, and the Venture Exchange Index is comprised of there's more exploration mining companies in this index than there are any other companies. Yes, there are also some software companies and a few other companies, but this index is heavily comprised of exploration mining stocks, and it's really the best one that we have as a proxy for exploration mining. So you can see that when exploration stocks get cranking, they can move, and they can move up a lot more even than the price of gold. And by plotting these on the same axis, we can actually see that there are times when the TSX Venture Exchange was going up dramatically more than the price of gold was back in the early 2000s. And look at the divergence today. Gold has broken out to new all-time highs, but the exploration mining index is still kind of plumbing its decade plus long lows. Really, there was a low in 2015, and we had a nice move up in 2016. A lot of people think that was the bottom for the broader mining industry. But then during COVID, we came around and kind of retested those lows, went even lower on this TSX Venture Exchange Index, and it's kind of like a triple bottomy thing here. We're just building this massive, huge base. In our analysis, we are extremely undervalued. There's 718% upside in this index just to get back to its prior highs in 2007. So gold has already broken out to new highs for the exploration index to get back to its prior highs, 718%. Now Crescat, we are looking for the best explorers, the companies that are making the new big discoveries that will drive this overall index. And many of the companies that we own in our portfolio are in this index and have some big discoveries. Quentin will be talking more about those. Let's go on to the next. Now, in this chart, we're looking at the TSX Venture Exchange Index again, but now we're looking at the dollar volume. So the amount of actual in USD equivalent trading, the money flow coming into these stocks. And what you can see is those two spikes that we had in the index back in 2016 that really continued on to 2018, and during COVID in 2020 and the early 2021, you can see, look at how when the money comes into this space, it doesn't take a lot of money. So we're looking at the inflows coming into the space of from 250 to 350 million dollars of average daily volume. Okay, 250 to 350 of average daily volume into this entire index of largely exploration focused stocks. They are small, and some of them even micro cap, but they're small cap stocks. But so when you have an inflow of 200 to 350 million dollars per day into the sub industry group of mining stocks, it can really move the overall group. And that's why the overall venture exchange index went up 80% from 2016 to 2018, and it went up 225% in 2020. But remember what we just showed, that to get back to its prior high back in 2007, it would need to go up 700%. So when you think about the billions and billions of dollars of flows of money going into S&P 500 stocks and mega cap tech stocks, compared to this entire industry and the sub-industry group, where it can only take, a few $100 million worth of daily flows to get this index cranking, this is what we're waiting for. And what does it take to get the flows going? Well, first it takes gold breaking out, it takes silver breaking out, and it probably takes a rollover, this what we've been calling for, this great rotation. It takes the overall S&P 500 and these mega cap tech stocks, it takes some money coming out of those things to start to attract money into these commodity industries. It takes inflation picking up. But we are starting to see these things. We haven't seen the flows come in yet, but I think it's coming. Let's go on to the next. So this is a chart that Tavi pointed out to me. One of the, it's from B of A, Equity Quant Research. This is the average recommended allocation to cash by Wall Street strategists. As you know, at Crescat here, we believe we are at or near a major market top, an S&P 500 market top, according to all kinds of valuation and sentiment indicators. This is just one other sentiment indicator of strategists recommending their lowest weighting to cash going back to 2006. It's crazy. Let's go down to the next. Credit spreads. So this is looking at investment grade credit spreads, courtesy of Bloomberg. And we're again at record tight credit spreads. This is a contrarian indicator, something that you see near market tops, ahead of recessions. Everything looks great, right, at the top. Strategists recommend being fully invested in the stock market and holding no cash and not holding any gold at the top. That's just how it works. And it's just another indicator, that contrarian indicator, that we are in very frothy market top type of territory here. Let's go on to the next. The city U.S. Economic Surprise Index. So they have two different versions of this, a hard data version and a soft data version. Soft data is basically surveys, economic surveys. Hard data is actual economic numbers. And when you look at the surprise, good versus bad for the economy, the surprise, there's, the hard data is starting to diverge relative to the soft data. So there's still a lot of optimism in the surveys, but the actual economic data that's been coming in has been surprising to the downside. Another potentially important divergence here at a potential market top ahead of something that's getting ready to happen here. Let's go on to the next. So here we're looking at a JP Morgan survey of their clients that is showing that no one's short the 10-year Treasury. We have an almost non-existent short position in U.S. 10-year Treasuries. I point this out because we have a short position in long duration Treasuries. We're long the 2-year note. We're short the 30s. It's a yield curve steepener trade. It's duration matched. This is in our global macro fund, but because of the record length of time that we've been in a period of yield curve inversions, not only is this a signal of an oncoming recession and a potential equity market meltdown. It is a trade opportunity to play the steepening of the yield curve, which happens when you're going into the recession, when you're going into a market crash. And again, we like to be contrarians, so we would much rather be short the long end of the curve when nobody else is short. Well, guess what? According to JP Morgan, no one else is short. Let's go on to the next. This is a chart that Nathaniel put together. Today was another strong employment report. Remember, unemployment is always strong, low, right ahead of recessions. That's what happens. But we look for divergences, and what you're seeing is that in terms of part-time employment for economic reasons, this data is spiking, the year-over-year change. Part-time employment for economic reasons. And what does that signal? Again, the shaded areas are recession. So you normally start to see this increasing, right as you're going into a recession. I know it's impossible to believe that we could be going into a recession right now because everything is so great. AI is so fantastic. The stock market is screaming higher, and everyone has jobs, and AI is just a wonderful thing. But we're looking at the economic data. This is what we are seeing. We also see record valuations in the stock market on par with 1929 and the tech bubble in 2000. There are risks and warnings to watch out for, and we're seeing inflation starting to pick up again. This is a wonderful environment, we think, for rotating out of overvalued large cap U.S. equities and into undervalued commodities and precious metals, oil and gas stocks, but especially undervalued, handpicked exploration stocks, handpicked courtesy of Crescat and Quentin Henney. What a great time to be putting money to work in precious metals. We think, let's go on to the next. This is my last chart, I believe. And again, it's just another study of market positioning out there. This one from B of A, and it's the positioning. At Crescat, we're value managers. We're value investors. We look for value. There, we see a lot of value. We see value in places that other people aren't looking. But where is most of the world positioned right now? They're not positioned in value. They're positioned in momentum. So this is the record underweight now among portfolio managers, according to B of A's research, in momentum stocks versus low PE stocks. So managers are the most underweight low PE stocks relative to momentum that they've ever been. These are the contrarian types of signals and positioning that we like to look at. We want to be opposite the crowd. When no one else is invested in value, and when everyone's invested in momentum, that's when we like to be short momentum and long value. And that's basically what we are in our global macro and our long short portfolios, both of which are performing very well month to date, by the way, and had a great month last month. I know we at Crescat, we kind of been going, fighting some of the trends here, sticking with our principles and what we believe, in the last year plus. But I think that conviction and that commitment and consistency to our core position and our values, I think it's going to pay off, and it's starting to pay off now.